Gold's next move, why it's dropping now, and where it's heading before year-end. Gold isn't just a metal. It's a scoreboard of fear, liquidity, and power. So when gold drops, it's never random. It's a message. And tonight we decode it. If you want deep, data-driven finance with zero fluff, hit subscribe now. You'll leave this video with a year-end map for gold that most investors never see. Let's start with the truth. Gold falls when real yields rise and the dollar tightens. Not headlines. Not drama, math. Real yield equals nominal Treasury yield minus expected inflation. When the Fed signals higher for longer, real yields climb, the dollar strengthens, and gold loses oxygen. That's part 1. Part 2 is liquidity. When markets rotate into carry trades, earning yield in dollars, money market funds, and treasuries, gold gets less love. It's not that gold is hated, it's just not paying you 5% to wait. Part 3, positioning. Futures traders on COMEX de-risk fast. When momentum flips, algos amplify the move. That's why drops feel sudden. It's leverage unwinding, not demand disappearing. But here's the part almost no one talks about. While paper gold sells off, physical gold doesn't always agree. We watch 3 quiet signals. Central bank buying, especially from M countries hedging currency risk. Shanghai premium, when Chinese demand pushes local prices above London quotes. Vault flows and ETF redemptions, GLD, IAU outflows can pressure price short term, but often set the stage for the next leg higher once weak hands are out. Now, why is gold dropping now? Because real yields have been sticky, the dollar bid is alive, and risk markets recently repriced, soft landing. That cocktail starves gold, temporarily. So, where does gold go before year-end? We're not guessing. We'll build 3 scenarios using the only levers that matter: real yields, dollar momentum, central bank, physical demand, and event risk. Bull case, 30 to 35% probability. Real yields roll over as rate cut expectations firm. The dollar stalls on twin deficit fears and easing growth. Central bank buying re-accelerates. Shanghai premium stays positive. Geopolitical premium resurfaces. Energy shocks, conflict risk. Outcome: gold grinds higher into year-end with sharp upside spikes on data misses and risk-off days. Base case, 45 to 50% probability. Real yields drift slightly lower but stay positive. The dollar ranges. Physical demand steady. ETFs stabilize after redemptions. Outcome: sideways to up chop. Bottoming behavior. Higher lows, failed breakdowns, bid on dips into data releases. Bear case, 15 to 25% probability. Real yields push higher on sticky inflation or a hawkish Fed signal. Dollar breakout squeezes shorts. ETF outflows persist. COMEX net longs get cut. Outcome: one more leg down that capitulates weak hands before an end of Q4 mean reversion bounce. Now the under the surface signals I want you to track. These are the between the lines that the media rarely explains. Term premium and Treasury supply. When the US floods the market with new issuance, yields can rise without growth improving. That hurts gold short term, but often creates the next buying window once auctions clear. Curve shape, 2s, 10s. A steepening from deeply inverted levels, especially bear steepening, long yields up, is gold negative at first. Later, if steepening comes from cuts at the front end, bull steepening, gold likes it. Energy gold link. Oil shocks raise inflation expectations. If yields don't rise as fast as inflation expectations, real yields fall, gold bullish. AISC and miners' behavior. All-in sustaining costs for miners create a soft floor. When spot approaches marginal cost, supply discipline kicks in. Price elasticity improves on the next demand impulse. Basel III and bank balance sheets. The shift toward recognizing physical gold as a higher quality asset slowly improves structural bids from institutions, quiet but persistent. Catalysts into year-end. Circle these on your calendar. 2 remaining Fed meetings. Minutes. Dot plot color. Tone moves real yields. CPI and PCE prints. Downside surprises soften real yields. Upside keeps pressure. Payrolls and unemployment. Labor cracks equals cuts sooner equals gold tailwind. Treasury refunding announcements. Supply waves equals temporary yield spikes. Seasonality. Q4 jewelry demand. India, ME, China can underpin dips. ETF flow inflection. Watch for the first week where outflows stop. That's often your turning point. So how do you trade or position this? If you're tactical, fade extreme dollar strength into data days. Buy gold on failed breakdowns when real yields stall. Pair trades, long gold versus short high beta FX when risk wobbles, or long gold versus underperforming miners after capitulation reversals. Respect liquidity windows. NY morning for data, Asia late session for physical cues. If you're strategic, scale in on weakness. Don't chase spikes. Split entries across catalysts. 1 tranche pre-Fed, 1 post-CPI, 1 into seasonality. Keep dry powder. Gold rewards patience more than bravado. If you're hedging, long-dated calls after pullbacks can cheapen downside regret. Pair with cash flow assets so you're not forced to sell gold at the worst time. Mid-video reminder. If this is the level of clarity you need, subscribe now. I post the map, not the noise. Let's close with the question everyone asks. Where could gold be by year end? I don't give magic numbers. I give conditions. Gold moves higher if real yields soften, the dollar stalls, and physical demand stays firm. Gold chops if real yields hover and the dollar ranges. Gold dips once more if real yields jump on sticky inflation or a hawkish Fed surprise, then mean reverts as supply, demand rebalance. This is not a coin flip. It's a set of dials. You watch the dials, you ride the moves. If you want my one-page gold year-end dashboard, the exact indicators I monitor and how I react when they flip, comment GOLDMAP below. And if you want deeper weekly updates with the real charts behind this, hit subscribe. The next video, Dollar Peak, the 3 signals that unlock gold's rally. Gold is not a rumor. It's a regime. Learn the regime, and you won't fear the dips. You'll use them. End of script.